Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Thursday, the 3rd of October, 2024. So, as usual, before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast prediction or presentation. Any forecast prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term intraday technical outlook on the various broad-based cross-asset classes, let's have a recap what has taken shape yesterday in terms of news flow, events, data release, and their impact on the intraday movement of the broad-based cross-asset prices. And I will share with you all one longer-term fundamental and intermarket dynamics that is at play in one of the broad-based cross-asset classes right now. So yesterday, there's actually two things to actually mention. One is the release of the US second tier job data report, the ADP employment change. Right, so let's look at the ADP employment change first. All right, so the ADP employment change data came in way better than expected. All right, so this is not actually some people might actually misinterpret this. This ADP employment change data is not the official job data in the US. So the official job data in the US is still the non-farm payroll data that is released by a specific government agency. Whereas the ADP employment change data, the calculation is slightly different from the non-farm payroll data. They are actually being calculated by a private sector organization. So sometimes that's why you see a bit of disparity between the numbers of the ADP employment change and the non-farm payroll data that will be released tomorrow. So the ADP employment change data was actually much more better than expected by around 23k. So it came in at 143k. Market is expecting 120k. All right, and also way above the previous month of August number, which is 103k, and it was actually revised slightly upwards from 99k. So given this rather upbeat ADP employment change data that actually came in way better as expected, but I want to stress again, the calculation of ADP employment change, which is being done by a private organization, not a government, not a US government agency, it's slightly different in terms of calculation from the official non-farm payroll data that they will tend to release every first week of the month. That could be on Friday. So that is actually released by the government agency, and these two calculation, ADP and non-farm payroll data is slightly different. So sometimes you see that disparity in the numbers, right? That means i.e. ADP employment change could be very good. Tomorrow, non-farm payroll data may not be as good as the ADP numbers that was reflected yesterday. Okay, but nevertheless, it has a short-term intraday spillover impact to the market. What happened in the market? The FX market reacted the most significantly, where the dollar strength actually came into the picture. Okay, because of this strong ADP number, it reduces the odds of the Fed being much more ultra dovish as being priced in the market 2 or 3 days ago. So what happened in the FX market over here, we start to see a very strong dollar resurgent strength coming back into play over here at this point in time upon the release at this period here. Okay, at 8 p.m. Singapore time, you see this spike up, and this dollar strength resurgence, right, is the most pronounced against the dollar yen. So you look at this dollar yen, this is the dark blue line, the dollar yen actually rallied up. So this dollar yen rally, right, has also been more or less been political driven internally in Japan as well. On top of that, better than ADP job data, because the new Japanese PM Ishaba, due to his we call it hoping to actually get his party being the major party in the parliament again, because he called for this snap election on this month 27th October, and due to his this political driven aim of getting his party to be the majority party after the snap election on 27th October, he keep on putting a bit of what I call pressure on BOJ not to hike rate so soon. Okay, so what he did mention over here is that yesterday he has a meet up with BOJ governor. All right, over here. So he did during the conversation, he actually mentioned Japan Ishiba, which is the new PM, rules out BOJ interest rate hike for now. All right, so it's a bit more of a political driven thing ahead of that 27th of October, we call it snap election in Japan. So that actually gave the dollar yen spiking up above our short-term pivotal resistance that we have yesterday at 145, around the 145 figure level. It broke out. That after it broke out this 145 figure level, it rallied all the way by one big figure to 146.20 mark, which is the next resistance level that we are watching as well. So later I'll touch on more about the short-term intraday technical outlook on the dollar yen. But nevertheless, due to this kind of, we call it political pressure that the new PM has on UDA right now, preventing him from making interest rate higher in Japan at this point in juncture, a bit of a call jawbone to cement his party stronghold in the upcoming 27th of October election. So I believe that after 27th October has ended, more or less the dollar yen could actually much more reflect according to the fundamentals instead. All right, so now and then there could be a bit of what I call political jawbone by the current Japan administration towards BOJ on and preventing BOJ from potentially doing what it's supposed to do in terms of normalizing interest rate in Japan. Okay, that means getting Japan interest rate on the higher plateau rather than the lower plateau. Then things will be more clearer after 27th of October, which is the end of after the Japan snap election, where potentially the dollar yen could move in line with the global macro factors that are at play. Okay, so this is something to take note of. Okay, because of this political jawbone situation that is impacting the movement of the dollar yen as well against the current macro factors. Okay, then what does this has impact on the so-called the broad-based US stock indices? So broad-based US stock indices remains rather lackluster yesterday. So what we could see over here is that almost unchanged movement. The SPX was unchanged, the S&P was unchanged, the Nasdaq up slightly only 0.15%, the Dow Jones also almost unchanged, and the Russell 2000 down slightly by negative 0.09%. So overall, right, net what you could see over here is that there was some form of hesitance by the major US stock indices, given the fact that we also have this kind of geopolitical risk premium on the rise as well, coming up from the Middle East region as well, that could actually potentially see a bit of hesitance by market participants to actually increase their risk on bets on the US major stock indices, at least on a intraday basis from here. And another thing I want to highlight over here is the CME Fed Watch 2. So despite the fact that yesterday we do have a rather strong, better than expected ADP employment change data for September, the movement on the pricing of the next interest rate cut, upcoming cut in the November meeting, 2 days after the US presidential election, 7th of November, remains still rather unchanged. I mean, at the start of this week, market has already started to reduce the odds of a 50 basis point cut. So after Fed Chair Powell, the speech saying that Fed will take its time to actually start its interest rate cut cycle, there is no guarantee that it will keep on continuing imposing 50 basis point cut in the next two meetings. All right. So that hasn't really changed at all. So after yesterday's better than expected ADP numbers, the market still remains rather high, and it was 63.2 before the release of the US ADP data 1 day ago, pardon me. So it only increased by 1 basis points to 64.1 after the release of yesterday's ADP rose better than expected job data. So 44.5% to 4.75%, implying only a 25 basis point cut at this moment in time, as priced by the US 30-day Fed funds futures market, compiled by the CME Fed Watch 2. So only a small chance of 36% odds market is looking for a 50 basis point cut. All right, so initially there was a week ago was 57% chance, and right now the odds has been greatly reduced to 35% chance. All right, after a slew of Federal Reserve officials speaking, including Fed Chair Powell, and yesterday's stronger than expected job data. But things could change again because this number is live, it's not static. After tomorrow US non-farm payroll data, which I stress again, the non-farm payroll data calculation is slightly different from how the ADP numbers are being calculated. And if you look at overall on an aggregated basis, market are still looking for one mega 50 basis point cut before the year end, which is at the 18th of December FOMC meeting. So how do we know that? How do we see that? Because let's assume that market has more or less been it's a 25 basis point cut for now at this juncture, being priced on the 7th of November meeting, bringing the Fed funds rate to 4.5%. Then after that, we see a high chance of 79% chance to bring it down to 4%. So the difference between 4% and 4.5% is 50 basis point cut. So it implies that the 18th of December meeting, despite that the market current information that they have right now, which is yesterday's ADP data, which is rosier than expected, but market is still looking at least to end the year on the 18th of December with a 50 basis point cut with a chance at 79% chance to bring the Fed fund rates down to 4% to 4.25%. All right, so this is how we interpret looking at this table. So what we could see over here is that there is still dovish expectation that is being priced into the market in terms of the potential 50 basis point cut at this juncture, okay, before the 2024 ends at the 18th of December meeting. So this is something to highlight for you all. All right, so now with that, let us now jump into a longer term fundamental and intermarket dynamics that is surrounding the China market. All right, the China market. So before we start the technical chart, let me share with you all this relative monthly performance of the global stock market across the world. So this from 2nd of September all the way up to 30th of September. So it's the trading days for the month of September. So what you could see over here, let me put it bigger so that you guys could see. Okay, I think this should be large enough. Yeah, good. So the top performer right now across the group was actually China and the Hang Seng Index, due to the very strong positive market reaction to this potential upcoming forceful, or I would say that anticipated fiscal, not monetary, because monetary policy they really cut interest rate. Now market is anticipating much more, not piecemeal right now, more forceful expansionary fiscal policy targeting consumer spending that potentially could be announced this month after the last Thursday Political Bureau Expo's meeting statement that they highlight the tonality. They actually use very strong tonality to actually vote to prevent the property market from slipping further in terms of the prices, and to actually juice up consumer confidence. So that's actually lead to a kind of a anticipation that the next fiscal policy stimulus announcement will no longer be piecemeal, but will be much more forceful and directly addressing consumer spending and consumer confidence. That means, i.e., it could be a more direct subsidy or potentially vouchers or stimulus to encourage consumer spending. Okay, direct to address the crux of the problem. But that led to a very strong outperformance of the Hang Seng Index, which is up by 19% for the month of September, and the CSI 300 is up by 23%. And all this return came only last week. That means majority of this return, I would say 90% of them, came last week. Okay, that managed to actually surpass the S&P 500, which only at 2%, and even surpass the rest of the Asia Pacific major stock indices ex Japan. So we measure it by MSCI Asia Pacific ex Japan, it was still up by 7%. Okay, 7.85%, and even the other EM markets as well, MSCI EM, which is managed to record a gain of 6.8%. And if you look at from the relative strength performance, so what I do over here is that I actually measure the relative strength of the popular traded exchange traded fund of China that is listed on the US stock exchange. That means, i.e., these are quoted in dollar, not in yen. iShare China Large Cap, the ticker code is called FXI. Invesco Golden Dragon China, PGJ. Over here, PGJ. Crane Share CSI Internet. So this is more of the China big tech company, like the likes of Alibaba, Tencent, Baidu, or whatsoever. KWEB, KWEP, and I divide it by the global stock market ETF. They call it the MSCI All Country World ETF. Ticker code is ACWI, and this All Country World ETF, I would say that it has a significant weightage on the US stock market, given that in terms of total market cap, US is the largest in the world. So it makes sense that this ACWI, a significant portion of it is skewed towards the US stock market. But nevertheless, what you could see over here is that since February 2021, the China ETF, that the three key China ETF that is listed in the US stock exchange, denominated in US dollar, has been underperforming. And this so-called 3 years of underperformance has starts to change after the ratio refusing to break its October 2022 low. So this is considered as a major basing formation. And what we could see right now is a change of momentum that could potentially see a kind of multi-week to multi-month outperformance of the China stock market, as being represented by these three key listed ETF, China Concept ETF in the US, outperforming against the rest of the world. And the momentum has also starts to be positive as well, based on their 10-week rolling momentum. If I have to take into this ratio chart into account, that means the FXI divided by the ACWI 10-week rolling momentum, and I compare it with the PGR divided by ACWI 10-week rolling momentum, and the KWEB divided by ACWI 10-week rolling momentum. All of them has starts to flip into positive territory in fact, this week as well, last week and this week, because the ETF market in the US is still trading, despite that the A-share market is closed for the Golden Week holiday for this week, and they will reopen next Tuesday. But what we are trying to express based on this intermarket dynamics on the ratio chart of this key China ETF against the rest of the world, potentially it could be showing multi-week to multi-month outperformance. And like I stress again, this is a multi-week to multi-month time frame. On an intraday basis, there could be some kind of sharp pullback on the Hang Seng index as well, and even the China A-shares, because it has rallied by a fair bit already in the last 2 weeks or so. So that's a bit different where I cover the intraday technical outlook. So just put it away a different time frame. Whatever I share you in the fundamental and intermarket dynamics, those are longer term horizon, and it will play out within a multi-week to multi-month time frame. All right, so with that, now let us now jump to today's intraday movement. All right, so this will be the intraday, very short term for today, good for only 1 day or 2 days. That will be the intraday technical outlook on the various broad-based cross asset classes. All right, so before we start, let me expand my screen first. All right, so let us start with the FX market. So on the FX market, we know that the dollar rallied yesterday, so we have a neutrality stance on the euro dollar because of that mixed element. And right now the euro dollar actually came down, hit the 50-day moving average. So that was also our lower limit of our neutrality zone that we have yesterday. So upon hitting the 50-day moving average, what we could see right now, there is actually a bullish divergence that has already been formed on the hourly RSI. So indicating to us that yesterday's sell-off, the downside momentum has slowed down from a intraday basis. Again, I stress because this is the hourly chart, not a daily chart and a weekly chart. Potentially there could be some kind of bounce taking shape on a intraday basis as well. So with that, I'll be using slightly lower the 50-day moving average, this graphical minor swing low here that was tested 2 times, 11th of September and 12th of September last month. 110 figure level, also a psychological level as well. So I use this 110 figure level as my short-term pivotal support for today. Flip back to a intraday bullish bias for a potential bounce scenario ahead of the non-farm payroll data that may be released on Friday. First near-term resistance level to watch will be 110.80. Only a surpass above 110.80 potentially expose 111.12, 111.20, pardon me, 111.20 on a intraday basis. Okay, only if the price action refuses to go up and comes down and break below 110 figure level on the hourly close below it, then it will invalidate the intraday bullish bias to see the continuation of this minor corrective decline sequence to expose the next support level at 109.45 and potentially even further 108.90, which is the minor swing low area of 5th of August and 9th of August, and as well conferencing with the 200-day moving average as well. Okay, so that's for the euro dollar. So on the sterling pound, or the cable, the sterling against the dollar. So the cable remains unsupported yesterday, so it came down, test the support, and right now it bounced, and during today's Asia session it tried to test again at this 132.50 level. So I actually have a zone today slightly lower at 132.15. So what's 132.15? If I do the Fibo retracement of this previous push up from 11th of September all the way up to the high of last Thursday, 26th of September, it correspond to the 50% Fibonacci ratio. All right, so a bit of excess at the bottom, so I'll be using a 132.50 / 132.15 as my short-term pivotal support for today. Still maintain that intraday bullish bias, but right now we do have a shorter term, near-term resistance level to watch out for, will be 133.10. Only a breakout above 133.10 may revisit 133.70 for today. All right. However, if price action starts to break down below 132.15, the lower limit of today's short-term pivotal support zone, with an hourly close below 132.15, then this intraday bullish bias will be invalidated to kickstart a kind of a extension of this minor corrective decline to expose 131.50, followed by 131 figure next, which is the rising 50-day moving average, I think, as coming to act as a support area at the 131 figure level as well. So that's for the sterling dollar. So now turning our attention will be the Asia Pacific pair against the dollar, starting with the Aussie dollar. So we know that the Aussie dollar has been pretty much hesitant at around the 69 figure level. So what you could see over here is that this 69 figure level, they can't have a proper breakthrough in the last 3 days. All right, and it starts to form this bearish candle, a shooting star. Then thereafter it closed below 69 figure, and yesterday it formed a kind of another kind of a shooting star as well, quite the gravestone doji. So it seems to us that the last 3 days of price action is kind of unconvincingly unable to break above the 69 figure level, and yesterday we do have a 68.70 short-term pivotal support level. And given the daily candlesticks, we know that in technical analysis, higher time frame price action takes precedent over lower time frame price action. So given the higher time frame price action is not so rosy, my conviction to remain bullish on the intraday basis has been reversed. All right, given the last 3 days of lackluster movement on the daily chart of the Aussie dollar. So with that, we will actually now flip to a intraday bearish bias instead for a slight dip down to revisit the 20-day moving average. So using 69.40 as my short-term pivotal resistance level for today, we'll flip to a intraday bearish bias on the Aussie dollar Next near-term support level to watch 68.25 followed by 67.86. That means something like a mean reversion decline scenario in the first on the intraday basis to retest the 20-day moving average, which is at 67.87. However, it's only the price action managed to clear above 69.40, then this bullish impulsive sequence may continue on the Aussie dollar to seek out the next near-term resistance level at 69.80 followed by 70.10 on the intraday basis. And also right now, if you look at the price action, it starts to break down below the minor ascending channel support level as well from the low of 11th of September. All right, so now turning our attention now to the dollar yen. So the dollar yen, after breaking up above the 145 figure level that we have yesterday as a short-term pivotal resistance, this strong push up, it managed to hit the next resistance level, which is the minor swing high area of 2nd of September at 3rd of September at 14720 level during the Asia session, and right now it paused over here. And during the hourly candle, it formed a bearish candlestick reaction over here. Okay, so with that, with the hourly RSI at the overbought level, but there is no bearish divergence, no bearish divergence right now because price action continues to trend upwards as a higher high. So given the fact that there's no bearish divergence, there may be no such of a clear significant pullback in place. But since it's at being at the overbought level, I would rather turn neutral right now because there's a risk of a minor pullback. So for the dollar yen, no conviction of any directional movement today. So kind of a switching to a neutrality stance on the dollar yen, neutral between 1720 and 145.45 for today. All right, so neutral between these two levels. Unless we start to see the price action breaking down below 145.45, then potentially there could be a much more deeper pullback to revisit 144.40 and 143.10 level again. Okay, so that's for the we call it intraday technical outlook on the dollar yen. And before we go on to the major stock indices, there's one particular FX cross pair I want to share with you all that has a very interesting technical configuration right now on the intraday basis, which the hourly chart, which is the Euro Sterling. So we know that the Euro Sterling, which I was featured I think 2 weeks ago in one of our daily dose segment, where we do have a intraday bearish bias, and the intraday bearish bias has really hit the support level at the 161.80, and thereafter it managed to float down lower, and where it actually tests right now is a 160 figure level, psychological. But if you go to the daily time frame, it's very, very important. So the daily time frame was this level over here, that previous V-shaped recovery that was flagged out on 26th of June, also at the 160 level, and now it paused at this level. And upon hitting the 160 level on the intraday basis, the hourly RSI also has starts to shape a bullish divergence as well. Over here, price action show lower low, but the hourly RSI starts to flag out a series of higher high, okay, indicating that the last few days of downside momentum has slowed down. And we also see a bullish breakout on the RSI as well in today's Asia session right over here, indicating that this particular down move scenario is losing downside momentum, and we could be potentially ripe for a mean reversion rebound on the intraday basis. So with that, I'll be using 160 figure level as my short-term pivotal support on the Euro Aussie, potentially for a mean reversion rebound scenario taking shape. First resistance level to watch will be 161.80 followed by 162.60. Only a breakout above 162.60 may open up scope for the next resistance, near-term resistance, to come in at 163.70, which is confluencing with the downward sloping 20-day moving average. Only a breakdown below 160 figure with an hourly close below it resume this impulsive down move to expose the next near-term support level at 158.50 next. Okay, so this will be the Euro Aussie short-term intraday technical outlook, one of the FX particular FX cross pair to take a look at for today. Now with that, let us now start our intraday technical outlook on the major stock indices, starting with the Hang Seng Index or the Hong Kong 33. So bear in mind that Hong Kong 33, we have a first resistance that we highlighted yesterday at 22,660. Then we did highlight that if this resistance level can't possibly break out, there could be a potential pullback scenario taking shape. And right now, this pullback scenario is unfolding right now with a bearish divergence that is being flagged out on the RSI from here. Okay, so with that, given that it still has room to run over here at this juncture, so we will be using 22660 for today because it's a very short-term technical outlook for the intraday basis. So as long as, okay, maybe we have a first resistance level, which is today's this level here. Okay, this will be the first resistance, but as long as price didn't surpass above 22,660, the Hong Kong 33 right now is showing some form of risk of a mean reversion decline, since that it has really rallied by a fair bit, leaving away the 20-day moving average by a huge gap. Right now we could see it graphically as well. So flip to a intraday bearish bias, 22,660 short-term pivotal resistance level. Potential mean reversion near-term support level to watch. The first level will be at 20,880/590, which was a Tuesday minor swing low. Only a breakdown below 20,590 may offer up scope for a deeper minor decline scenario or deeper mean reversion decline scenario to expose the next near-term support level at 19,790. But if price action continues to go up and break above 22,660 with an hourly close above it, we got to respect the bullish impulsive price action, which invalidate today's bearish bias scenario for the mean reversion decline scenario to see the continuation of the impulsive up move to expose the next near-term resistance level at 23,550/670, and after that 24,750 next, which is the 2-time Fibo extension level. And if you go back in time on the daily chart, that 24,750 correspond to this congestion area here, 20th of June and 20th of January and 31st. Where is it? Okay, this level here. Okay, it's actually this level here, 21st of January and 10th of February 2022. Okay, so that's for the intraday technical outlook on the Hong Kong 33 with the risk of a mean reversion decline below 22,660. Okay, over here. Now, turning our attention now will be the Japan 225 or the Nikkei 225. So still recall Nikkei 225, we do have a bullish bias with a tightened short-term pivotal support level at 37,830 yesterday. Price action hit the first resistance zone, 38,620/38,920. Then thereafter it shake a pause right now. So as usual, the RSI hit the overbought level and now do a bit of retracement. So first support level to watch will be at 38,160 for that potential minor pullback. Still using 37,830 as my short-term pivotal support level to maintain that intraday bullish bias on the Japan 225. Next resistance level to watch after 38,920 will be the last Friday minor swing high at 39,790. Only a breakdown of the hourly close below 37,830 will invalidate today's intraday bullish bias to see another round of choppy minor corrective decline to revisit 37,410 and 37,090, which is the 20-day and the 50-day moving average acting as a support, and as well as the minor ascending trend line support from the low of 6th of September. Okay, 6th of September. Okay, so that's for the Japan 225. Okay, turning our attention will be the German 30. So the German 30, no change. The support level to watch will be at 19,050 level, short-term pivotal support. But on the intraday basis, right now it got to very clear above yesterday minor swing high at 19,270 before increasing the odds to revisit 19,460/19,550. However, if we start to see an hourly close below 19,050 level, then that will invalidate today's intraday bullish bias to kickstart another round of minor corrective decline scenario to revisit the 20-day moving average that is acting as a support level at 18,820 next. Right, so that's for the German 30. Now, turning our attention will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30, no change, continues to trade sideways above the short-term pivotal support at 41,950. So still maintain that intraday bullish bias, but price action got to break out fast above the yesterday's near-term resistance level or minor resistance level that has been capping the price since Tuesday this week at 42,410. A breakout above 42,410, potentially revisit last Friday minor swing high at 42,730. Next, only an hourly close below 41,950 will invalidate today's intraday bullish bias on the Dow Jones or the US Wall Street 30 to kickstart a minor corrective decline scenario to expose the first near-term support level at 41,535, which is the 20-day moving average. A breakdown below 41,535 sees 41,120 next, which confluence with the rising 50-day moving average as well. So that's for the US Wall Street 30. Turning our attention will be the Nasdaq 100. Still continues to congest within a range-bound scenario, so no change. Maintain a neutrality stance between 20,000 and 19,630, and the RSI continues to print a series of lower high. Okay, lower high over here, indicating the lack of upside momentum. So still no change. Neutral between 20,000 and 19,630. So only a breakdown below 19,630 exposes a kind of a intraday corrective decline scenario to expose the next near-term support level at 19,380, followed by 19,120 next. So 19,120 is close to the 50-day moving average, and as well as this medium-term ascending channel from the low of 5th of August. Right, so that's for the Nasdaq 100. Okay, so now turning our attention now will be the commodities market, starting with gold XAU/USD. So for gold XAU/USD, still remains bullish. Price action came down, shaped a potential rebound during the later part of the US session. So still no change. Still using the 2,625, which was last Tuesday V-shaped recovery as my short-term pivotal support level, also pretty much close to the minor ascending channel. So the minor ascending channel right now, support level, since the low of 9th of September, okay, is at this level here. Okay, yesterday's lower, which is at 2,640. So I don't put it so tight. Still using 2,625. Short-term pivotal support level. Still maintain that intraday bullish bias on gold XAU/USD. First near-term resistance level to watch will be 2,692 on an intraday basis. Okay, so in fact, there's one more slightly lower, which is this level here. Okay. Okay, two resistance to watch, 2,674, followed by then after 2,692. However, price action starts to break down below 2,625, then today's intraday bullish bias will be invalidated to kickstart another round of minor corrective decline sequence to expose the next near-term support level at 2,590, which is the rising 20-day moving average acting as a support level, 2,590. All right, so that's for gold XAU/USD. So now turning our attention will be the West Texas crude oil. So the West Texas crude oil yesterday hit the upper limit of our neutrality range, which is 73.15. So what's this 73.15? If you go to the daily chart, 73.15 is a key level to watch. Why? Because this 73.15 was a former major symmetrical triangle range support level. This dotted green line here, drawing from the low, linking the low of 20th of March 2023, 13th December 2023, and 5th of August 2024, where price action breakdown and shape a much significant decline on the daily basis. So now this is a kind of a pullback major range support turns into a former major range support turns into a pullback resistance, a bit of tongue twisting, and also correspond to the declining 50-day moving average as well, that is acting as a resistance very closely at the 73.15 level. So this level here also indeed a level to watch where, because the price action reacted negatively on a hourly basis from here. So with that, we will still maintain a neutrality stance, neutral between the 20-day moving average that is acting as an intraday support level, neutral between 70.10 and 73.15. Only a price breakdown below 70.10, then potentially a much more forceful short-term intraday bearish movement could lead it to revisit this week intraday low at 68.15/67.45. All right, so still maintaining that neutrality stance for now between 73.15 and 70.30, and also given the very fluid geopolitical tension rising up from the Middle East situation right now. Okay, that potentially sum up today's intraday technical outlook on the broad-based cross asset classes. So what are the key events to look out for today? So on top of this situation that we got to monitor in the Middle East, because it's rather fluid, because right now Israel said that they will retaliate after yesterday Tuesday attack, Iran missile attack on Israel soil, and the option that Israel use could attack will be potentially key installation in Iran, nuclear sites, and potentially it could also include oil refinery site as well. So the things are pretty much fluid, and right now US and its airline is trying to dissuade Israel from doing so, but Israel hasn't get back yet, okay, in terms of whether they would listen to US persuasion at this juncture. So something to keep a lookout for in the news wire on this Middle East geopolitical risk news flow. And on top of this Middle East geopolitical risk news flow, what are the data to look out for today in terms of the economic calendar basis? So today economic calendar will be rather quiet session. What we have over here is another second tier US job data, which is the weekly initial jobless claim, which is much more volatile, releasing at 8:30 p.m. Singapore time. And one important data to look out for will be at 10 p.m. Singapore time, which is the ISM Services PMI data. So this ISM Services PMI data is much more important than the ISM Manufacturing PMI data. Why? Because two-thirds of the US economic growth is driven by services industry. So that's why the ISM services data is important. And the ISM service data tends to have a leading impact on the growth environment in the US. So market is still looking for a healthy blip at 51.7, slightly above 51.5 that was printed in the previous month of August. And also bear in mind to take a close eye or watch on the ISM services employment subcomponent. So this is the potentially a survey-based data on the job market situation on the average pertaining to the services industry in US. So previous data printed at 50.2, so it's actually dipping downwards over here. So you look at the trend of the employment situation in the services component, it slightly dipped downwards from 51.1 in July. So if this month it continues to dip down again, especially if it dip down to below 50, which is in a contractionary mode, then that could actually rise out another potential scare in the job market situation in US that has started to turn softer, because given the fact that the services sector plays a key role in the US economic growth. All right, from here. So other than the ISM services employment data, what are the other data to look out for today? Over here, yeah, we have another Federal Reserve official speaking at 10:40 p.m. Fed posted is speaking at 10:40 p.m. And throughout the early Asia session, there will be nothing, no key data that is pretty much important that we covered according to our cross asset classes. All right, so with that, these are the key data and events to look out for today. And also this will be Kelvin here signing off for today's daily dose session, and have a great day ahead, and we shall speak again tomorrow. Thank you.